The United States government just tipped its hand. For the last 72 hours, investors have been glued to the Comex ticker, watching silver struggle around the $90 level. Charts were dissected, dips were debated, and the same anxious question echoed across the market. Is the bull run over? But while the public fixated on the screen, something far more important happened behind the scenes. While traders obsessed over volatility, the United States Mint quietly updated its internal pricing system. There was no press release, no public announcement, no warning. Just a silent adjustment made by the sovereign authority responsible for America's coinage. And the number they published was not a routine increase. It was a confession. We have confirmed reports that the U.S. Mint repriced the proof American Silver Eagle at $173. The uncirculated bullion version was repriced at $169. Let that reality settle in for a moment. The screen says $90, but the government says $173. That is not a normal premium. That is nearly a 100% spread between paper silver and physical silver. This is not market noise or a temporary distortion. This is the sovereign leak, the moment the issuer of the currency admits that the currency itself is broken. The skeptics will immediately object. They will say the mint is closed, that sales are suspended, and therefore the price does not matter. But that argument collapses under scrutiny, because this price matters more than anything else in the market right now. Why would a government agency that is refusing to sell silver go into its system and nearly double the price tag? Why bother updating anything at all if sales are paused? Because they are front-running reality. They know that when sales resume, whether next week or next month, they cannot sell silver anywhere near $90. If they did, the mint would be instantly looted. They would be dumping a strategic asset at a fraction of its real replacement cost. By setting the price at $173, the mint is signaling where it believes the true clearing price actually is. They are telling you that the paper price is fiction. It is a derivative illusion with no connection to physical reality. This creates a two-tier market. In the first tier, paper traders on Wall Street swap digital contracts and pretend silver is worth $90. In the second tier, physical buyers, mints, refiners, and industrial users know that if you want metal, you must pay double. That disconnect is the definition of a broken market. When the spread between paper and physical reaches $80, the exchange is no longer discovering price. It is discovering insolvency. Now think about the psychology this creates. If you are a retail investor and you see the government pricing silver at $173, are you going to sell your stack for $90? Of course not. You are going to hold. You are going to wait. You are going to realize that your asset is worth far more than the banking system is willing to admit. This is devastating for short sellers. Banks need selling pressure to survive. They need weak hands dumping metal so they can cover positions without detonating the market. But the U.S. Mint just told every silver owner in America to hold on for dear life. They unintentionally created the ultimate diamond hand narrative. And look at the timing. This repricing happened on a Friday afternoon, immediately after a failed attempt to smash the paper price. Banks tried to force silver down to $86, and they failed. The market closed above $90, marking the first weekly close above that level in history. And in response, the Mint repriced silver at $173. That is not coincidence. That is escalation. This is a war between two realities. The paper market is deflationary, designed to protect the dollar. The physical market is inflationary, governed by scarcity, energy costs, and production constraints. The U.S. Mint has chosen a side. By pricing at $173, they aligned themselves with physical reality. They admitted that the purchasing power of the dollar has collapsed. This is what a currency crisis actually looks like. It is not an overnight collapse to zero. It is a series of repricings where real assets leap higher to compensate for monetary decay. We are living through the great repricing. The screen says $90. The mint says $173. Only one of those prices allows you to actually obtain silver. The paper price is a coupon. The physical price is the asset. And coupons expire. But while the mint was sending a signal, something far more alarming was happening inside the vaults. On Friday, the Comex warehouses experienced one of the largest single-day silver withdrawals in history. We analyzed the daily CME warehouse reports for Friday, January 16th. These reports are usually boring, filled with minor inventory shuffles. But this one screamed bank run. In a single trading session, over 4.2 million ounces of silver were physically removed from Comex vaults. That is roughly 130 metric tons. This was not retail buying, it was strategic evacuation. The withdrawals were widespread and coordinated. Metal was pulled from Asahi, CNT, JP Morgan, and MTB. Every major custodian was hit. And here is the smoking gun. This massive withdrawal occurred on the exact same day the paper price was smashed to $86. That was not an accident. The banks engineered the flash crash to create cover. If you withdraw millions of ounces, every dollar matters. A $6 drop saves tens of millions instantly. They smashed the price to loot the vaults. But the most dangerous number was not the withdrawal total. It was the collapse of registered silver, the metal available for delivery. Registered inventory plunged by over 2.5 million ounces in one day. Registered silver is the safety buffer. It is the metal with a for sale sign attached. And that sign is being ripped off at record speed. When registered silver vanishes, it means insiders are pulling metal off the market. They are converting public inventory into private hoards. Why now? Because they know what is coming. They know about the Section 232 review. They know silver is being eyed as a critical mineral. If export restrictions or price controls are coming, you do not want metal sitting in public vaults. You want it private or offshore. Much of this silver is likely heading to London or Shanghai. Both markets are already under extreme strain. Arbitrage gaps are draining inventories globally. The banks are playing whack-a-mole with metal shortages. They are robbing one vault to plug another, but every hole is already leaking. This vault drain marks the final stage of the squeeze. Liquidity is dying. The exit doors are closing. And this brings us back to the mint's $173 price. They know the vaults are being drained. They know they could not source millions of ounces, even if they wanted to. The metal is spoken for. The paper price says $90, but the physical supply says default. At this rate, registered inventory would be gone in roughly 30 trading days. That takes us directly into the March delivery month, a historically massive delivery window. Open interest suggests traders want metal now. But if the vaults are emptied beforehand, delivery becomes impossible. That is the force majeure scenario. Cash settlement replaces metal delivery, and industrial buyers will not accept checks. This was not just a transaction. It was an insider exit. Meanwhile, a third force is entering the battlefield: retail investors. For the first time in history, retail buying has become relentless. Data shows silver ETFs have seen net inflows for 169 consecutive days. This is not a flash mob. This is a migration. Billions are pouring in but into paper vehicles. ETFs absorb demand while physical silver disappears behind the scenes. That is the trap. Investors think they are buying silver. They are buying claims. And when claims exceed atoms, the system breaks. The banks are short billions of ounces that do not exist. Retail demand is rising. Vault supply is vanishing. The vice is tightening. There are only two ways this ends. Either the mint is wrong or the paper price explodes upward. One of those outcomes is impossible. The great repricing has begun. The era of cheap silver is already over in the real world. The banks are trapped. The metal is gone, and the only way out is up.